Okay. So whether it is bonds, whether it is equities, whether it is derivatives, anything, not necessarily even a wind velocity or the speed of a horse, people could bet on through derivatives. So then wherever there is volatility, there is a model to capture the volatility or predict the volatility. So this VAR number. Duration you cannot apply for an equity or a what is it? Exchange rate. Similarly, a position as a risk measure, you cannot very ipso facto. It means in the same manner you cannot apply for a bond portfolio. So this VAR will be additive across asset classes. There can be a VAR for bond portfolio, VAR for equity, VAR for gold, VAR for currency, VAR for JPY, VAR for US dollar, any way you want. So additive across asset classes. So total portfolio level for the whole bank VAR number. That is how we arrive at it. Okay. So that is the what you can say, the beauty behind the need for such a common volatility indicator. Now, how was this VAR model built? So again, I'm reiterating, you need not go into an Excel and find out how and not. That's, from an examination point of view, that's not required. After 90 marks, you come as a dealer, maybe you will be more comfortable having your own VAR model. So that's all at that point of time. Now, I said two things about VAR, value at risk over a given confidence level, overnight, 1 week, 1 month, 1 year, and over a horizon, and at a confidence level of 95%, 96%, 97%, 99%, like that. You cannot touch 100%. Why you cannot touch 100%? We will cover very shortly in a graphical form itself. Okay. Now, we said standard deviation is the one number which will look at the dispersion around mean, and therefore one standard deviation translates into a confidence level of 68.20%. 1.65 standard deviation translates into 95% confidence level, and from 2.33 to 3 you take, still the confidence level does not jump to 100. It always remains something below 100, 99.60. So this is just an indicative science behind how a VAR model takes standard deviation number to increase the confidence level from say 95 to 99. Now, what is a normal distribution curve? A bell-shaped curve. Everybody would have learned in their 12th standard statistics about normal distribution curve. If you visit a science exhibition somewhere in some of the museums and all, or technology parks, you will find some metal particles being attracted on a magnetic field, and then they get themselves arranged in this kind of a graph. So it's all about a normal distribution curve, bell-shaped curve, it's called in the text. Now, this green is the first one standard deviation, that is -1 and +1. And the central straight line is the center of the mean, and then -1 and +1 add together 68.2%. So that is covering one standard deviation. Now, 2 standard deviations you increase the confidence level to 95, because the observations fall equal to half of 95 on one side and half of 95 on the other side, the green and the yellow together. And then 3 standard deviations, you increase the confidence level to 99.5, I put there, or 0.6 here, 0.9. So this is just a cut and paste from a Google, so that is why I have not corrected it. So that minor difference and all, don't break your head. But suffice it to say that as you increase the standard deviations, your confidence level increases. So why the normal distribution never touches the x-axis? Now, this is the correct curve. So it will go, as you increase from 3 standard deviations, it will start moving parallelly to the x-axis on both sides. It will never touch. That is why whether you put 4, 5, whichever standard deviation, you will be still short of 100. Now, what does it mean? I said, no. Standard deviation is 12 means minus 88 plus 112, and 100 is the center. So that is where all the action happens. And we are worried, or we are concerned about where we should be in the action area. But if something, so under normal conditions of normal temperature and pressure, as you read in your physics examination questions or chemistry examination questions in your high school, under normal temperature and pressure, this will happen. So if some abnormality were to happen in the market, like Putin pounces on Ukraine, of course, there was some announcement earlier, build up of forces, everything, but overnight, if there was a pouncing, then there would have been an abnormality. And then you don't know whether, even then US dollar gained strength. US dollar index was around 75, 78 at the beginning of this calendar year, January 2022. Today is at 115. So see the movement, around 16, 17% appreciation has happened. Or strengthening has happened in the dollar index. Similarly, suppose Atal Bihari Vajpayee, the nuclear blast, Buddha smile, that was a code word for blasting the nuclear device. And then USD INR, which was trading at 33, immediately shot to 37, 38. So something unexpected, and the market reaction. These are what are the gap between that x-axis and the parallelly running curve. So that is called outlier events. What is not captured in the normal temperature and pressure situation is the outlier, which lies outside the bell-shaped standard deviation curve. That is called the outlier event. So this explains the plotting of the volatility and then expressing it as a number as the maximum likely loss. Under normal conditions, having taken 3 standard deviations, I am saying that my bank's maximum likely loss overnight will be 28 crores. VAR number 28. I have arrived at that. Another bank may say my VAR number is say 18 crores. So like this, you bring it down to a single number for your bonds, for your equity, for your non-SLR, for your mutual fund, for your currency, everything put together, a single maximum likely loss. Be clear, questions will come. It is not the absolute loss. It is not the minimum. Maximum likely loss. Likely, okay, not the absolute. Under certain, this confidence level that we can capture it. Right? Now, so some methods for calculating the VAR, just to make you understand only, you need not break your head. What is that method? Variance covariance method, historical simulation, Monte Carlo simulation, and then Black-Scholes model. There were Nobel laureates, Black-Scholes model, who created that model, 2 people. It's a single number. It's a simple number. It's an intuitive number. There is some element of subjectivity depending on whether you are taking 2 confidence levels, 2 standard deviations, or 3 standard deviations like that. Then additive across business units. You can have the VAR number added for your bond, equity, mutual fund, currency, everything. And you can say in one number, what will be the maximum likely overnight loss, 1 week loss, 10 days loss, like that. Okay. And in very, very loose terms, mean into standard deviation, you can say as the valuations. That is just to make you sensitize you on that only. Mean into standard deviation is what. You need not by heart that. Now, what is this outlier event? I already gave a glimpse of when a nuclear blast was done by India, how the currency moved, or when, say, a war happens or a flood happens, a very, very extreme winter. And then there is also an OPEC cartel coming in on oil production. So the US is definitely going to make huge demands for oil, and therefore petroleum prices can shoot up. So like this, certain things which a model cannot capture will be an outlier event. So this outlier event led to the fall of long-term capital management, the rise and fall of long-term capital management. In between, you will see the book is called When Genius Failed by Roger Lowenstein. It captures the rise and fall of long-term capital management, which was a hedge fund run by Nobel laureates, this Miller and Scholes, I think. And they prophesied that their model will capture all the risks and their war model is unbeatable. So everybody put money and they gave good returns also. But then they had made huge bets on the Russian ruble, and Michael Gorbachev introduced the reforms process of glasnost and perestroika, and then the USSR crumbled, disintegrated, and then the ruble also lost value, and this fund also lost value. Then US government through their HDFC type, the Freddie May and the Freddie Mac and the Freddie May, yes, two HDFC type housing companies, they pumped in money and rescued this company. So everything is captured in When Genius Failed. How an outlier event was overlooked by two haughty, the hubris, two Nobel laureates said their model will not fail, but their model failed. So that is all about outlier event. Now, not one. This is coming. 1 second. Yeah. Now we will go to. I have just altered the slide order from what is shared with you, because I want to cover the concepts first. The what is the theory part of it as given in your book. Some of them will come in the end that I am covering here, and the derivatives part alone I have shifted back so that there is continuity. So I'll cover this also and then go back to derivatives from the next slide. It will come in the end. Now, what is asset liability management? We knew that as a single measure, you can calculate VAR about volatility. You knew that what is different types of risk, liquidity risk and funding risk. We will analyze that in detail shortly. And then we also know how a marking to market has to be done on the portfolio. Only on HTM, you need not mark to market, whereas AFS and HFT, you have to mark to market. If your bank's DV Sans period, the maximum period up to which you can hold a bond in your HFT category is 60 days, that is your DV Sans period. RBI puts the maximum DV Sans period at 90 days, after which either you have to book the loss and sell it or shift it to AFS at the lower of the market value or book value and recognize the depreciation loss there. And then AFS no limits, and all non-SLR securities can be held only in AFS or HFT, whereas only SLR securities can be held in HTM. And every quarter you have to market both your AFS and HFT portfolio. Within each category, appreciation in one can be netted against the depreciation in other, but inter se between equity, between mutual fund, between government bond, whatever is the appreciation in one cannot net it off against the appreciation in the other. So these kind of things we looked at. Now we will capture it in a risk management perspective from the Market Risk Management Committee, which is also called the Asset Liability Committee of the bank. Chief Economist Soumya Kanta Ghosh of SBI sits in the ALCO. He gives out the ECO wrap every fortnight. He comes out with a newsletter. So like that, it is a very high profile job in any bank. So the entire maturity profile of the bank, both in terms of liabilities and assets, now with the aid of technology, everything is there in core banking. You can plot, and from that you can work out what is the liquidity, how you can manage the liquidity, and how under Basel III, RBI has introduced some liquidity coverage ratio as a measure. It will be covered in D also, module D. Interest rate view. What is the bank's interest rate prognosis? Interest rate view about, unless you have that view, you cannot take it or decide on whether to go long or go short. Then ALCO also looks into transfer pricing, that is your deposit-oriented branches, giving that deposit to the central office for being utilized or deployed in advance-oriented branches, and then in turn getting compensated through the transfer pricing mechanism. Then balance sheet management, both in terms of CRAR, capital adequacy, and in terms of liquidity, so liquidity coverage ratio, and then interest position, whether you are on a more of risk-sensitive assets or more of risk-sensitive liabilities. We will be covering that shortly. Then each bank should have a documented contingency liquidity plan, which is also part of the liquidity management and to be supervised by ALCO. And two statements through which RBI monitors under the offsite surveillance and each bank's ALCO also monitors is through the statement of structural liquidity and dynamic liquidity. We will look into that in detail, and through the gap reviews, whether you have a positive interest rate gap or a negative interest rate gap. A gap means a maturity mismatch. In foreign exchange, you have AGL, aggregate gap limit, and IGL, individual gap limit. We will cover that very shortly. Now, how a structural liquidity statement for a bank is drawn. Okay, RBI says essentially you break the maturity profile of the bank into liquidity buckets, and the first four buckets are overnight, 2 to 7 days, 8 to 14 days, and 15 to 28 days. Then you move over to 3 months, 6 months, 1 year, and 3 years, and beyond that. So like that, now you plot. Now, how do I plot my savings bank balances? So you do a behavioral pattern analysis. What has been my core savings bank over the last 1 year? कभी भी से 5 लाख करोड़ से नीचे नहीं गया है. My minimum SB balance at balance sheet level has been 5 lakh crores. Today it is at 6 lakh 20,000 crores. So 5 lakhs is my core SB balance, which I can categorize under my long-term bucket of say 3 years and above. And this 1 lakh 20,000 again, in that the maximum volatility has been for about 30,000 crores. So the 30,000 you split in your overnight and 2 to 7 days, and balance 90,000 you split into your 8 to 14 and other long buckets. Like this, you do a behavioral pattern for where there is no defined maturity. Then fixed deposits, as per maturity date, you can plot them. But there again, with a behavioral pattern, you know what percentage gets renewed or rolled over, so that you can put it in your longer term buckets. Similarly, your bill portfolio, you know the defined due dates, you know when the asset is falling due. Whereas in a cash credit, you have to undertake a behavioral pattern analysis, and the core portion you say as non-volatile, and the long-term, and the volatile portion you categorize under short-term buckets, these four buckets. Again, some science of your bank's logic. So once, and capital, you don't have to repay your capital, so you put it in the long term. Tier 2 bonds you have raised and falling due in the third year. So third year you put that as a outflow. So like this, wherever there is a defined maturity, you plot it in the respective maturity. For non-defined maturity, liability and asset classes, you undertake a behavioral pattern and then plot it with the core and volatile portion and distribute it. Now, once you have done that, you can put all outflows, liabilities falling, maturing, or some payments due, or some disbursements which have been committed. Everything will come in outflows. All assets falling due or repayments happening in your EMI due dates and things like that will come as inflows. So once you know the outflows in the four buckets, when you keep on adding them, you know the cumulative outflow. First bucket 80, second bucket 200. So 200 plus 80 is what is the B280. Then 280 plus 260, 540 outflow. Then 540 plus 90, 630 cumulative outflow. Similarly, you know the inflows for the four buckets. So cumulative, you know the inflows will be added together like that. Now, what is the mismatch in the respective bucket? So cumulative outflow is 80. Outflow is 80 and inflow is 70. So respective bucket mismatch is 10 outflow. 2 to 7, 200 minus 185, 15 outflow. Third bucket, 260 minus 175, 85 outflow. Fourth bucket, 90, 230, 40 inflow. Now, if you do the cumulative mismatch, you add 10 to minus 15, you get 25, 25 plus 85, 110. Then 110 minus and plus 140, you come to 30 cumulative mismatch. What RBI says is as a percentage the cumulative mismatch to the outflow in that bucket, to the outflow. Cumulative mismatch to the outflow, E by B, should not exceed, read the last line, 5%, 10%, 15%, and 20% of the respective CEO. Whereas for this bank, somebody needs to mute himself. Please, somebody mute yourself. Check your left icon.
Sir, E by B did not get, sir.
That is what I have written. E is cumulative mismatch. B is cumulative outflow. So minus 10 by minus 80 is 13%. Minus 25 by minus 280 is 9%. Minus 110 by minus 540 is 20%. And plus 30 by minus 630 is minus 5%. So RBI says the cumulative mismatch as a percentage of the cumulative outflow should not exceed 5% in the overnight bucket, 10% in the 2 to 7 bucket, 15% in the 8 to 14 day bucket, and 20% in the 15 to 28 day bucket. So once this is not complied, these two red areas, there is a non-compliance. So ALCO will have to revisit their contingency liquidity plan and if necessary, raise resources by, say, issuing CDs or raising some wholesale deposit, something like that, or sell bonds and generate liquidity and bring the mismatch to within 5% overnight and 15% in the 8 to 14 days bucket. So this is how you work out on the structural liquidity. Similarly, now here I have already put that 5 to 20%. Similarly, on the interest rate sensitivity, dynamic liquidity is what we look at. And for that, you bucket all your assets and liabilities as whether they are rate sensitive or rate insensitive. Now, fixed deposits, especially when they fall due, they become sensitive to interest. And even if in between you raise interest rates also, so many people will come for premature closure and then roll over. So like that, your cost goes up in an rising interest rate scenario when you have rate sensitive liabilities. Overnight call money. Suddenly Shaktikanta Das raises repo rate to say 540 to 590 or 590. Then 590. Then 50 basis points. So call money also increases, say 595, 6% like that. So your liability price increases. Liabilities. So that is how you look at it. Then current account, maybe to the extent they are in current account, they are not rate sensitive. But supposing you have a sweep account and minimum balances you sweep into FD or short maturity deposits, that portion becomes rate sensitive. So like the capital, not rate sensitive because what you pay on capital is dividend. Okay. Then fixed maturity, Tier 2 bonds, 10-year fixed rate. So you don't increase the rate, not a rate. But bonds are rate sensitive because you suffer a price investment, I'm saying. You suffer a price risk. But as far as the coupon is concerned, there is no sensitivity on interest rate. So like this, when you have more rate sensitive assets than rate sensitive liabilities in your balance sheet and interest rate moves up, what happens to your net interest margin? You have 1,500 crores of rate sensitive assets like your loans or bills or your investment in bonds, and their rates go up. Whereas you have 1,000 crores of FDs and liabilities, current account balances, SB balances, and their interest rate also goes up. So net interest margin in the scenario of an increasing interest rate and you have a more RSA than RSL, NIM increases or decreases?
Increases.
Yes, beautiful. Increases because 1,500 crores your earning income interest goes up, whereas only 1,000 crores your interest expense goes up. More assets get repriced at higher rates, NIM increases. So if your chief economist has given a view that your in the market interest rates are going to go up, then in the ALCO you should give direction to the operating units to have more rate sensitive assets. That means don't give fixed rate term loans, invest more in 90-day bills, that is bill discounting portfolio. Like that you decide, or give more floating rate loans. Like this, you give direction to the balance sheet which is in sync with the interest rate expectation. Similarly, if the RSA is less than RSL and interest rate increases, your
Sir,
NIM
full form of RSA, RSL, sir.
rate sensitive asset, rate sensitive liability.
Okay.
Yeah. So it is just the mirror image. So I'm putting everything there so that the concept is clear in your mind when you look at the presentation. So with this, another way of looking at it is how if interest rate asset is more than RSL, we say your rate sensitivity gap is positive. And if rate sensitive liabilities are more than rate sensitive assets, your interest rate gap is negative. And interest rate increases, suppose you give a positive direction to a rise in interest rate, two positives make positive, whereas two negatives also make a positive. So you don't have to by heart whether it will impact your NIM in a negative way or positive way. RSA greater than RSL, rate increases, both are positive, NII is positive. And RSL greater than RSA, rate increases, both are, one is positive, one is negative, because we have given RSL greater than RSA. So that you have to give RSA the preference for that green color or positivity. So now again, so it is negative. So simple mathematics, plus plus is plus and minus minus is plus, whereas minus plus and plus minus both are minus in a multiplication. So same concept, just to run through so that you need not by heart. So whichever is comfortable to you, you can look at it from a understanding perspective. The previous slide and this slide are the same, but only two different perspectives of the same, assigning certain color codes. That's all.
Sir, one second, please.
बोलो.
Sir, 1 second, please.
बोलो.
सर ये इसको और एक बार समझा दीजिए सर.
किसको? ये स्लाइड को या प्रीवियस?
हाँ, ये स्लाइड को.
हाँ. So first you look at this one. RSA greater than RSL, that we are assigning as a positive gap. And interest rate increase, we are assigning as a positive direction. With this, we move on to understand this, that RSA greater than RSL is gap positive and interest rate increase is positive direction. So on the left-hand side, you have both positives. So when that happens, what happens? Gap is positive, rate movement is positive, NII increases. Whereas if you move on to the right hand side, RSL greater than RSA, the gap is negative and interest rate increases, rate positive. So NII niche aayega, negative. Just the mirror image. RSL greater than RSA, we have defined it as negative. Whereas interest rate decreases, again we have defined it as negative. So both of them together, two negatives, when you multiply, we get NII positive. Whether you put 1000 and 1500 on both sides and work out the logic, or give this color code and work out the logic, you get the same answer. It's up to you. That's all. I have just given two perceptions. Now, this is one.
We're talking about asset
Full
and
form of
liability.
NIM, sir. Full form of NIM.
Net interest income, net interest margin, we are covering. Net interest income is absolute, NIM is a percentage measure. We are covering it.
Sir,
Extensive.
sir,
Tell me.
one thing. Yes, like here we have written like asset about asset and liability, no sensitivity of asset and liability. But we
Correct.
are talking about interest rate. So interest rate of asset or interest rate of liability will increase. That I haven't understood.
Interest rate
Like,
both uniformly in the market. It is not one alone. Okay, good. Interest rate in the market increases. So we assume that because RSA and RSL are rate sensitive, the liability price also, rate also increases, the asset rate also increases. That is what we assume. That difference in the rate at which the increase happens is what we capture in basis risk, which we will be covering shortly. Good question. Have I answered you?
can you please show the previous slide? Here, asset in rate sensitive assets we have more, and then that of rate sensitive liability. When we have more assets, then we have fun to invest. In that way, we have to consider, or like, how come this
No,
positive
don't
and
look at,
negative
see,
have not
again, you are all building more scenarios. Will I make profit? But asset greater than liability does not mean you have more fun to invest. That's a wrong logic. You have invested somewhere. Only thing is your rate sensitive assets are more. Okay. So you have lent more in call money perhaps, and interest rate increases. So what happens? You tomorrow the rate at which you will lend that money in call will be at a higher rate. So your NII will go up. Whereas liability is greater than asset means only 500 crores of call money you will lend at higher rate, whereas your current account or SB will get repriced at a higher rate, and your interest expense goes up. So your NII will come down. That is why I have put a red in the and below NII in the 1, 2, 3, 4th column. So logic, how you want to apply yourself. I have given you 2 tools to look at. Simple. Don't break your head too much. Whichever is comfortable, you spend time on only one perhaps. Like this is contributed by one of the students only. She only gave me this green and red, then I put it into a slide. Okay. She said, why I should by heart? I can use this. Then I said, beautiful. So last time I added this out of her inputs. Okay. So now this is question. Following are the components of a bank's balance sheet. If interest rate increases, now this will answer the previous question. Somebody asked, liability ka interest rate बढ़ जाएगा या asset? Both. In the market, if interest rate increases by 2% uniformly, what will be the impact on the net interest income? So call borrowings, SB, current account, FD, and equity are your liabilities. Cash, investment, cash credit balances, term loans, and bills are your assets. So first task is to find out how much of it is rate sensitive from liabilities as well as assets. So RSL and RSA, I'm going to find out. So 80 call borrowing, definitely tomorrow, again the floating rate, at what rate it is going to be borrowed depends on what is going to be RBI's announcement or what is going to be the liquidity in the system. So it's sensitive. SB balances, again sensitive. Current account, as they are non-interest bearing, we can take it as non-sensitive. FD sensitive because premature closure can come if we are going to raise the rates. Equity non-sensitive. So 900 crores of liabilities are rate sensitive liabilities.
Sir, how are you distinguishing between sensitive and non-sensitive? Please clarify.
Yeah. If tomorrow RBI raises the repo rate by 50 basis points, will your call borrowing price go up?
Yes.
It is linked to repo rate, no? So your call rate will go up. Similarly, SB is an interest bearing liability. So more money can either come into SB or more money can get shifted to other FD rates also, whichever way. Because it is interest bearing, it is sensitive to interest rate. So SB balances are sensitive, whereas current account, you don't pay interest. So that is the merchant has put that money for his daily operations. Whether repo is at 590 or 630, that 40 will remain in current account. So interest insensitive. Equity, you don't pay any interest bearing coupon on that. You pay only dividend out of your post-tax profits. So equity will remain in your balance sheet as a rate insensitive liability. So that is why I have put only 80, 120 and 700 as sensitive. So RSL is 900. Similarly, on the asset side, cash I keep for my daily operations. So whether interest rate is 590 or 630, cash I have to maintain. It is insensitive. Investments I can sell if there is an interest rate fall and book profit, or if there's an interest rate rise, I can put more money or either book a loss and then reinvest at a higher coupon. So all that becomes sensitive to interest rate. Cash credit balances, with PLR you link or MCLR you link, and once there is an interest rate increase in the market, your MCLR goes up, so the cash credit interest rate also goes up, so sensitive. Similarly, term loans, again, you quarterly reset or something. So again becomes sensitive. So like that, I have put 750 assets as RSA and 900 liabilities as RSL. So which is higher, RSL or RSA? RSL. So what is a gap? Gap is positive or negative?
Gap is
RSA
negative.
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 Negative. And interest rate increases. So NII नीचे आएगा या ऊपर जाएगा?
नीचे आएगा
Beautiful.
plus
So that itself is you are on the right track. Interest rate goes up, whereas this is minus. So minus and plus you multiply, it becomes minus. Okay, that much we are clear. Now how much? So 150 is the difference. The RSA minus RSL is 150. So 2% is what you lose on 150 crores for 1 year. So 3 crores will be the impact on net interest income. It will come down by 3 crores. Simple. Mathematics, no calculators. If you know the direction, everything is simple. So this is how. Yeah, this is how a question can come.
Hello.
Yes.
Sir, term loan, how can we distinguish as a volatile interest rate? Because it is being offered on a fixed rate, no?
If you are offering it as a fixed rate housing loan, it is not sensitive. But now most of the banks give only floating rate loans where they quarterly reset or whenever the MCLR changes like that. You go and read your sanction letter given to your borrowers. It will be on an MCLR linked. Plus 1% over MCLR, plus 2% over MCLR, like that. So, there it becomes reset sensitive. Okay. If it is fixed,
so here
the question is valid, it is not sensitive.
So here term loans means a long-term term loan.
And, whether it is long-term, whether it is 1 year, that is not the matter. It is term loans on floating rate basis.
Okay.
Good.
Thank you, sir.
Yeah. Now, liquidity risk is inability to meet cash flow obligations at reasonable cost. So it can be a funding risk. That means maturity mismatches. As I already said, you have invested in a 1 year CP and you have funded that through an overnight call money, which is your liability. So tomorrow at what rate you are going to borrow in call money to fund your 1 year CP, you do not know. You have a maturity mismatch. 1 year asset, overnight liability. Okay, you have a 10-year housing loan and you have a 3-year FD, maturity mismatch. So if the FDs are not rolled over, you will have a problem. Okay, Northern Rock Bank. Northern Rock is in the European Union. That bank had a very good CRAR, absolutely not much of problems on NPA, very good NIM, but they ran into a maturity mismatch and therefore liquidity risk forced that bank to fold up. So this is what is the Basel III is all about. So Basel III brought in that over and above your CRAR, you should also have liquidity coverage ratio and what is that? LCR and then the other one, high quality liquidity assets, HQLA. We'll cover in D module, it will be covered. So then there is a time risk, that is your performing assets turning into NPA and therefore the cash flows do not come in. Means you have put EMIs or your bill portfolio plotted in your liquidity profile, but the EMI does not come. Or
sir, your voice is not audible, sir.
Yeah,
lot of disturbance.
If somebody has not muted, please recheck once again. Please recheck. Yeah. Now, the EMIs do not come on time or the bill does not get mature, repayment of the matured bill does not fall on due date, then you run into a cash flow problems. So performing asset turns into non-performing and cash flow is disrupted. So what happens? Time risk happens. And the difference between a time risk and a call risk in one of the problems 2 days back, I visualized yourself as the CFO, treasurer. And then I said a call risk emulated when a guarantee was invoked. So this is what a guarantee of a getting invoked happens, a crystallization of a contingent liability. In the first day, I have shown you how a balance sheet is structured. The off-balance sheet items come as contingent liabilities, but when a liability is called, that means a guarantee is encashed, you have a crystallization of that contingent liability resulting in funding needs. So that is called call risk. So from an objective question, you please understand what could be a call risk and a funding risk. Very, very narrow difference between the two. But call risk will come from a premature closure or early repayment, or even a contingent liability becoming a funded liability. That is called crystallization. Now,
The embedded option risk is also.
it's also a call risk. Beautiful. I am coming to embedded option in a slide very shortly. Very good.
Okay.
It is call risk. Yeah. Now, 10-year home loan funded with 3-year FD. So maturity mismatch, you run a negative gap. 50 crore CD funding a 100 crore bill portfolio. You raised a 3-month 50 crore CD and you discounted a 3-month 100 crore bill. So 50 crores gap is there in terms of amount. Maturity, not much gap, but amount. So it can be a maturity mismatch or tenor, or it can be an amount mismatch. Both will impact net interest margin. What is NII? Absolute number of net interest income, and net interest margin is a percentage of the degree of your profitability. We will cover NIM shortly. So NIM impacted on repricing. Now, this is what is spread. Your average yield on advance minus average cost of deposit, and only deposit and advances coming here in spread. Okay, whereas what is NIM? Somebody was asking. Net interest margin, it is net interest income divided by average earning assets. Now visualize the balance sheet on the right hand side, the red squares. You have two earning assets. One is the investment red square, another is the credit assets, which is the following red square below. So both these together and only performing because sorry. Only on the performing assets you can recognize income. So only what is recognized as income is taken in the numerator, and the corresponding denominator is average earning assets. So as a formula, the investments also come in the denominator, and the income from investments comes in the numerator. In spread, the investments income and the investments do not come. It is only average yield on advances minus average cost of deposits in spread. But NIM is a more refined measure, better informed measure for an investor to whether to buy your stock or sell your stock. So your share value also depends on higher NIM. Normally in India, the average NIM for banks ranges between 2 to 3.5%, whereas what is that? Banks like HDFC, Kotak and all could be 3 plus, and some of the scheduled commercial banks will be at 2.5, 2.3 like that. That's just an indicator of industry average. So which share you should buy and which share you should sell in the banking sector. One indicator could be NIM. So all risks will impact the net interest margin. That is the risk perception you should know from a balance sheet angle. Now, how we can define some of the risks? Basis risk is the interest rate on assets and liabilities get reset at different points in time and at different degrees. So you don't know what will be the new price for a 3-month CD after 3 months, and what will be the new price for a 100 crore bill portfolio after 1 year. So in between, whatever happens is captured as basis risk. So this is the figurative representation. Blue is your liability, say 1 year FD, which was initially at 5%, and you gave a loan at 8%. So 8 minus 5 is your spread, which is 3%. Whereas after 1 year, your FD had to be renewed at 6.5%, whereas the loan remained at 8%. So your margin has shrunk from 3% to 8 minus 6.5, 1.5. So your basis risk, NIM, shrinks. This is the basis risk. So two asset or liability classes. Yeah, tell me.
Sir, what I understand that in Macmillan book, if the deposit rate is increased, that risk is gap risk. If advance rate is decreased from earlier rate, that is called basis risk. But you have told that
not necessarily, not pure complete understanding, I would say. Gap risk is a maturity mismatch arising out of either mismatch in price, maturity of liabilities versus the assets, whichever it is. But as a result of that gap risk, a basis risk comes in. That is what you should understand. It is not one against the other, one from the other. Okay, it will be more clear when I put one or two more slides, please. After that, if you still have doubt, you ask. Good thinking. So now, what is yield curve risk? What is basis risk? This is a diagrammatic representation for those who are going in for an elective paper and all, especially in derivatives. This is the basis risk, that towards maturity, the basis risk becomes zero because the gap in between for repricing is too short, or that risk is almost eliminated. So towards maturity, the basis risk converges. That is just for an understanding. Okay, don't break your head too much. Figuratively, how these are captured. Now, yield curve risk is non-parallel shift in yield curve. There is a difference between basis and yield curve. In yield curve, we look at one class in isolation. In basis, it can be an FD versus a loan, a CD versus a CP, a CD versus a bill, like that, two asset classes. Here, the blue line is the yield curve for CD. So 3-month CD is at 3% and 1-year CD is at 6%. So this is the timeline for the interest rate on a CD for 3 months, 6 months, 9 months, and 12 months, ranging from 3 to 6%. Okay. So with that liability, you can fund an asset, say a red line bill. You can fund a 3-month bill at 8%, or you can fund a 1-year bill at 14%. So this red line is moving from 8% to 14% as you move along the maturity 3 months to 12 months. So the yield curve for bill is the red line. The gap between the two is your NIM or spread. Loosely said spread. So shrink. This is the NIM, and here it is almost what you can say a rectangle. That NIM. Now, after a few months, suppose the CD rates go up too much in the 1-year maturity, whereas 3 months it does not go too much, from 3 to 4% increases, whereas 1-year CD it increases from 6 to 12%. So this green line is the new CD rate. So non-parallel movement, it has steeply risen, whereas the bill rate here has not risen in parallel. In one maturity of 9 months, it is still high, but towards 1 year, the bill rates are still lower than even the previous 14. So all this is looking at interest rate expectations and what is going to be the risk perception in the commercial market, whether commercial risk, corporate earnings are going to be at risk or not. Accordingly, there will be an interest rate reflection. So a bill class, asset class, the interest rate from 4 to, bill class which was 8 to 14 is now 6 to 13. Okay. And this violet or purple color curve. So what has happened? The gap which was between the blue and the red is now in an odd diagram as non-parallel shift has happened for the lower line as well as the upper line. They have not moved in tandem. So a shrinkage of NIM has happened, and at some point it is not linear also. This is non-parallel. So you should know the terms more. What is yield curve? Non-parallel shift. Like that, if you associate, that is enough. Okay, but we'll be explaining I'll be elaborating in detail. So this is just another movement of the 10-year or government bond yield curve in US Treasury for 4 different dates. So that green is February 15th, 2011. It was too steep. There was too much less confidence in the market, so longer term was too steep. Whereas July 10, 2000, the red top line is almost flat. Oh, interest rates were high, it was flat, and the longer term expectation was less than the short term. That is why it was coming lower. Okay. Whereas the bluish line is towards a curve, and the mild orange color is again expectations building up over the period to go up. So you explain different types of slope in the yield curve. So just like some terminologies, how you should be familiar. That's all. Now, this is again a US Treasury yield curve as of 8th July 22. See how the 20-year to 30-year expectation is different from a 10-year to 20-year. 10-year to 20-year, it is likely to go up only. That is why positive, going up slow. Whereas between 20 to 30 years, the longish term view is still rates are going to come down. So whatever is happening now about FOMC, about the US Fed rate going up 3.75% and all, is built up here in the 1 to 6 month bracket where it is steep. Then it almost plateaus between 2 year to 7 year. And between 7 to 10 years, it's a kinkish cut, the kink coming down. So all this is market expectations of interest rate diagrammatically captured as reflected by the YTM of the bonds of the respective maturities. So an yield curve is reflecting the market expectations. So this is the previous basis risk example I had mentioned. Now, one is mangoes, one is apples. The price of mangoes may go up because Alfonso, maybe Sindhudurg did not have good rainfall or early rainfall and the crop failed. So prices may go up. But apple prices, surplus apples or huge crop in Kinnaur or Jammu Kashmir, and therefore the prices remain where they are. So you cannot compare mangoes to apples in terms of similar movement in prices. It can be different for various factors. Therefore, there is a basis risk when two commodities are interlinked in price. Whereas in yield curve, we are looking at mangoes to mangoes, but 1 month, 2 month, 3 month, 30 year. So it can be a Alfonso mango to a peach or a Neelam or whatever term you want to give, or Rajapuri, like that. So one mango may become pricey, so it moves up. Whereas, but what is captured is the price of mangoes all over. So that is how you can relate better how to differentiate between an yield curve risk, because only one tenor is what is being discussed about one class, one instrument. CD yield curve, CP yield curve, yield curve, like that. Please mute yourself. Somebody is giving milk, water to his kid. Pani. Please mute. Please mute. Yeah. So this is how we can understand mangoes to apples and mangoes to mangoes as basis risk and yield curve risk. Now, this is the GSEC yield year on year, 1 year, 5 year, 10 year, 20 year, 30 year, and 10-year benchmark. So how the yield curve? Now, 1 year is very, very volatile, but you don't find so much volatility because the long-term expectations are almost docile, you can say. So this is how the government securities yield curve. This is Indian benchmark of various states. So I have taken it from, if I remember right, CCIL only. Yes. So like that you can get. See, now figuratively you are getting the indication, the mindset of the market through an yield curve. So now somebody asked about embedded option risk. This picture is about a, you can say, an assembly board, you can say. Now, the control panel executes certain commands when you press a button. So, where is that command getting triggered? The science or the signal for triggering that command, where is it lying? That is my question. On a washing machine, on a music system. Most of you will be engineering graduates.
Motherboard, sir.
Motherboard, beautiful. There is a motherboard beneath. There is a printed circuit board on that, and there it is embedded. That is why we call about embedded technology. All you would have learned about embedded technology. So this is embedded somewhere. Similarly, your customer who has deposited for a 3-year FD, after 6 months, when Shaktikanta Das has raised the repo rate, your bank also chose to raise your 3-year FD rate. He comes and asks for a premature closure and creating a new FD for 3 years. Now, where does he get the right to ask for premature closure? It is embedded in the account opening form in the covenants of the contract. That is why embedded options risk. Similarly, a customer can repay his housing loan now without penalty. RBI said earlier you used to charge pre-closure penalty. Now housing loans at least can be repaid without pre-closure penalty. So embedded option of shifting maturities, asking for premature closure or early repayment of loans is what is captured in. So we looked at basis risk, we looked at yield curve risk, we looked at embedded option risk. So this translates into when there is an early repayment of loans, you have more liquidity coming in to the bank. So you need to reinvest that liquidity. So you have a liquidity risk, surplus liquidity, and you have a reinvestment risk. Similarly, when somebody asks for premature closure of FD, you have a shortage of liquidity, and therefore you run into a reinvestment risk in terms of generating liquidity. That's all. So reinvestment more from the point of view of surplus liquidity, but shortage of liquidity, mostly liquidity. How you divest your portfolios. Now, just to make complete the discussions, I am also covering what is credit default swaps. This will be also part of your D module where you mitigate certain credit risks. But there is a passing mention about it in your B module, Macmillan book also. These are derivative contracts that trade in the credit risk alone. Credit default swap means only credit risk is traded. It is traded in the market at a price. The loan portfolio does not change hands. It remains in your bank, but the credit risk of that portfolio can be traded. Yeah. So what is to be understood here from an examination perspective is only negotiable and existing debt can be protected for default, not contingent debt or bank loan. Your term loan is not a negotiable debt. So you gave a loan of 100 crores to Maruti Udyog, you cannot undertake a credit default swap on the likely default by Maruti on the term loan. Sudha, I think please mute yourself. Please mute yourself. Please mute yourself. Yeah. So, but negotiable debt is a debenture issued by Maruti. It is a negotiable debt because it is a promissory note and it is covered under the Stamp Act and stamp document and a depository that is credited, so you can trade in that. So it's a negotiable debt and it is already issued. So a debenture. So if Maruti Udyog's debenture your bank has invested and you are sensing that there could be a default by Maruti because electronic vehicles are going to come in a big way and your traditional petrol and diesel vehicles are going to be defunct, and you are taking a negative view on Maruti's repayment capability, you can have a elevated risk perception on Maruti, and therefore it can translate into a need for a credit protection. Okay, you don't sell the debenture, but you can get an insurance of default by Maruti. How it will come, I am explaining shortly. Now, only principal amount of the debenture can be protected in credit default swap, not the interest. And this was one example of an auto ancillary unit, Amtech Auto. They were primarily supplying to all the major original equipment manufacturers, OEM to all these Marutis and Hyundais and Toyotas. Amtech Auto, they raised CPs, they raised debt, term loans, everything. And suddenly the rating agencies downgraded the rating. Of course, after the default, they defaulted the CPs and then Amtech Auto CPs were downgraded. Now, for banks, there is a risk perception of repayment not coming because the rating is going down from P1 plus to D. But suppose these original equipments are being supplied to Maruti, and Maruti always pays the bills only after, say, 90 days. So at any point of time, money is due from Maruti to Amtech Auto. So Amtech Auto is the default. Maruti defaulting is default on the CP in the market. Maruti can always have a fallback saying, this money I will not pay to you, but I will pay to the CP investor. He cannot automatically say, he can say that by issuing a credit default swap. Okay, so that is the derivative instrument. So he can take a positive view, that is, it is only temporary. We have cut down on our orders to Amtech Auto. By in another 3 months, Japanese economy will again come up. So our orders to Amtech Auto will go up. Our means Maruti. So Maruti can take a positive view on Amtech Auto, and therefore they can offer a credit protection to the investors in the negotiable instruments of Amtech Auto, like a CD or a CP or a debenture. So this is the principle of giving an insurance protection against default, credit default only. Okay. Now, just some terminologies. Reference entity on whom the credit protection is sold, in this example, Amtech Auto, and the credit provider is, or protection seller is Maruti, and the protection buyer is the investor who has invested in the CPs of Amtech Auto, the bank. Holder of a bond on the reference entity pays a premium to the protection seller, to Maruti. Bank pays a premium to Maruti for buying that protection. So the protection seller, Maruti, underwrites the default risk of the reference entity, which is called Amtech Auto. Just a product, you understand the broad.
Like channel financing.
Sorry?
Like channel finance.
Channel finance credit protection is not offered, but you can say.
But that company has to make a purchase only from or supply to their.
Correct. That is actually, you are throttling supply chain. And there it is a supply chain driven financing inventory, whereas here it could be various ways, and it need not be Maruti which is offering the credit protection. It can be a mutual fund. It can be a hedge fund. They can also offer. Whoever is having a positive view on Amtech Auto in the long term, he can come in and offer a credit protection. So that is, here it is different. Channel financing is purely whoever is going to shell out money for the inventory that is going to flow through the channel or the that supply chain. So I appreciate the thinking. It is similar, I agree, but not the same. Okay, good. So protection seller has a positive view on the default risk of reference entity, and therefore he earns a premium. Protection buyer has a negative view on the reference entity. Bank has a negative view on Amtech Auto, and therefore, in case there is a default, he gets the money. But he has to hand over that CP or hand over that debenture to the protection seller, Maruti. So that is how the negotiability comes in. So under the negotiability, the instrument under which a default happens has to be handed over to the protection seller, and protection buyer gets the consideration for the principal amount. On credit event, that is a default, protection seller gives par value. Protection buyer transfers the defaulted debt to protection seller. And all these are bound by ISDA documentation, International Swaps and Derivatives Association. ISDA documentation we will cover extensively in derivatives, but they are bound by ISDA documentation. Now, 2-3 topics on borrowing program of the government of India. Some questions can come because it is not extensively covered in BFM, but some questions I am seeing. especially C module not extensively covered, but elective risk it is covered, as well as D there is a passing mention. So anyway, I thought I'd cover that. RBI is merchant banker to government. I have already told elsewhere, because primary dealers underwrite the auction program. I told, and Nirmala Sitharaman can ask RBI to raise bonds from the market every week only after the budget is approved. And the second half-year borrowing program, 2 days back, RBI announced for the 4 lakh odd crores that the budget had approved for the government of India to raise through various maturity bonds for the full year. So around 2.2 lakh crores already completed up to September. So the second second half of the financial year, October to March, what is the borrowing program? The calendar they have already, RBI has published, and every week what is going to be the auction, everything is now in public domain. It is available. Earlier, everything was not so transparent. So, disclosure standards and data dissemination standards. If you look at Michael D. Patra, one of the RBI deputy governors who is a member of the MPC, he comes and speaks. So, it will be always mentioned about this DDS, data dissemination standards. So, these are all the areas where Indian RBI as well as India government is far ahead of several other countries in terms of engaging the market participants in a transparent manner. Now, FRBM Act, Fiscal Responsibility and Budget Management Act, under which the RBI cannot underwrite or monetize any borrowing program. Suppose there is a auction calendar this Friday, an auction for 10,000 crores, and market participants, banks and insurance companies and mutual funds bid only for 7,000 crores. The balance 3,000 crores, RBI cannot subscribe. Whereas primary dealers who underwrite the auction, they will have to necessarily subscribe. So if RBI subscribes, it tantamounts to printing of money, monetization of deficit, and attendant inflation. So the parliament has also given a mandate to RBI that the inflation should be within a band of plus or minus 2% on the anchor rate of 4%. So inflation cannot be below 2% or above 6% continuously for a long period. Then RBI governor will be called by the parliament and asked to be accountable and explain. But because of the COVID circumstances, now for the last nearly 2 years, it is above 6% inflation. But RBI has been given a long rope to bring the inflation below percent. Still, we are looking at a 7% numbers are coming in. Slowly, by raising the repo rate, they will bring the inflation below 6% is what is the expectation. Now, I have already explained this. The parliament mandate is 4% as the anchor, plus or minus 2% is the leeway. So inflation has to be maintained between the corridor of 2 and 6. And primary dealers are only people who can underwrite government auctions, for which they get an underwriting fee as the income, say 1 paise, half paise, 2 paise and all, per 100 rupees as the commission they get. And only on the primary dealers, the devolvement happens. So notified amount 10,000 crores, RBI cannot borrow more than 10,000 for that particular auction, but RBI has to necessarily ensure that the entire 10,000 is received. So if market participants subscribe only 8,000, balance 2,000, the devolvement happens on the primary dealers. There are 2 ways of auctions conducted by RBI: uniform price auction and multiple price auction. Uniform price is also called Dutch. In Dutch, there is a U. Uniform price starts with U, so you don't have to by heart. Dutch means uniform and French means multiple. That is my way of connecting. It's up to you. Okay. So uniform price is Dutch auction, multiple price is French auction. In uniform price, everybody who is successful in the auction program is allotted at the cutoff price. In multiple price, each person bids at a respective price, is allotted at the price at which he has bid. The difference will be very clear to you shortly when I present a problem. Please wait. Now, this is the uniform price auction method. the auction committee received the following bids. So YTM wise, it is increasing from 623 to 629. So higher the YTM, lower the price. As a merchant banker to the government, RBI wants to sell bonds at the highest price so that government gets the maximum money to meet its budgeted spendings. It can be on roads, it can be on bridges, it can be on defense equipments, it can be on food, but government wants the money. So this week, 10,000 crores the government wants to raise. So 97.25 is the maximum price at which somebody has bid. Give it to him at 97.20. I mean, collect 97.25. That is approach. And the lowest bid has come at 96.87. Consider him last if we need the money. Okay. Now, therefore, YTM corresponding to that price increases from 623 to 629. As YTM increases, price reduces. Another theory we are revisiting. Okay. So the bids are arranged in terms of the descending order of prices or ascending order of YTMs, and the amount people have bid for that respective price. At 97.25, SBI, a DBS Bank, and a Shamrao Vital Cooperative Bank have bid together 3,700 crores. At 97.19, the Canara Bank, Bank of Baroda, and a SBI Mutual Fund have bid. Okay, 2,500 crores altogether. At 97.12, some other four participants, five, whatever it is. Whoever has bid at 97.12, together 2,800. So like this. Now, the auction committee fixed the cutoff at 97.06. So 97.06, we will accept money and give bond. Uniform price. So everybody, 97.25, they will also get at 97.06. 97.19, they will also get at 97.06. 97.12, they will also get at 97.06. And now the question is, which is true? Uniform price auction. RBI will issue the stock for 13,000 crores. What is the notified amount given on top? 10,000. So can they issue for 13,000? FRBM Act empowers that the Parliament gets the mandate. And as per the respective notification for this Friday, notified amount is 10,000. So RBI cannot issue for 13,000 crores. Then all bidders of the stock will be allotted at 97.06. That is true. Then bidders at 97.06 will get 25% allotment. That we will see shortly. And bidders at 96.87 will get full allotment. Is wrong. That bid will be rejected. 97, 96.93 and 96.87 are rejected. Anyway, the total of all these, the top four is 13,000. Whereas RBI can borrow only 10,000. So these together add up to, the three together add up to 9,000. So the last 97.06 who have bid for 4,000 crores in all will be allotted only 1,000 crores more. So the proportionate allotment will be 1,000 for a bid of 4,000 or 100 for a bid of 400 or 25% of their bid amount for only those people who have bid at the cutoff. 97.25, they will get full 3,700. 97.19, they will get full 2,500 at 97.06 uniform price. At 97.12, they will get full 2,800 at 97.06. At 97.06, who have bid, they will get against 4,000 only 1,000 at 97.06. So uniform price method allotment at 97.06, and for those who have bid at cutoff, pro rata bidding. This will change from one auction to another depending on how much is the oversubscription at cutoff. So here in this example, it is 1:4 to 25%. Please mute yourself. This is a Dutch auction.
This 4,001 will get 1,000.
Sir, second
Why?
one I can't understand.
Yeah, why? Because total amount that can be accepted by RBI is the notified amount, which is 10,000 crores for this particular auction, whereas total bids received at 97.06 is 13,000 crores, of which the top three are adding up to 9,000. So remaining amount is 1,000 out of a bid of 4,000. So 1:4 is the proportion at which the bidders at cutoff are going to be allotted. Okay.
The first one, how many stock will he get?
He will get full. Suppose you are SBI and you have applied for 1,000 crores at 97.25. You will get 1,000 crores. Then Canara Bank has applied for 1,700 crores. They will also get 1,700 crores. Then UCO Bank has bid at 1,000 crores. They will also get 1,000. So entire 3,700 they will get for 97.06. Whereas at 97.06, if somebody has bid for only 100 crores, they will get only 25 crores. Because for 1,000 crores of bids, 1,000 crores of gap or remaining security to be auctioned, only already 4,000 have come in. So for 4,000 bids, 1,000 is going to be allotted 1:4, 25%. Somebody raised a hand. Praveen.
His bidding amount price is less, so that's why he will get the 25%.
That is why means he is at cutoff. That is the reason. And at cutoff, there has been an oversubscription, overbidding. Against a remaining amount to be auctioned of 1,000 crores, 4,000 crores of bids have been received at 97.06. That is why.
Sir,
Ask.
sir, please once again explain this.
Once again, I will explain the next step pattern. Then it will be clear. I am giving one more question.
So totally only 9.
Sir, is there any mechanism to find out the cutoff? Is there any process how the
Cutoff is
committee
there is a
will decide?
monetary policy auction committee. You also clear P-grade examination in RBI. In 10 years, 15 years, you will become one of the auction committee member as a DGM or GM of a monetary policy department. Then you will sit there and decide. The auction committee will decide what is the cutoff. Okay.
So it is prevailing upon the market conditions. They will decide.
Conditions. Exactly.
Sir, if X Bank takes bids for money of at 97.12 price, how much they will get, sir? What percentage they will get?
X Bank has bid at 97.12, 2,800 crores. They will get full 2,800 because they are above the cutoff. At cutoff only this problem comes. See, first 97.25 wala, you call all those people and give 3,700 crores. Then 97.19 walas, you call them and give 2,500. So you are given total 6,200. Then another 2,800 you give at whoever has bid at 97.12. So total you are given 9,000. Now the balance in the 10,000 is only 1,000. So you can give bonds for, you means RBI, can give bonds for only 1,000 more, whereas people are there for 4,000. So to each one you give 1/4 of his bid. So 25% allotment, 1,000 against 4,000. Now is it clear?
Sir, that means out of 10,000 only we have to decide it, right, sir?
All the other people will be discarded. 97, 96, 93, 96, 87. They are unsuccessful.
Sir, in this question, price at 97.06, how much he will get? 1,000 only, na?
If 4,000 crores is the bid from one participant, he will get only 1,000.
Because above it is 9,000.
Already 9,000 crores of bonds are issued. So balance, RBI has got the mandate for this Friday to issue only 1,000 more.
Okay, sir.
If someone has applied for 16,000, then?
Once again, ask the question.
97.65. If someone has applied for 16,000.
16,000. Now, in the notification, if you read, it will say a single participant cannot apply for or submit bids for more than the notified amount. Good question.
Sir,
So
if
notified amount is 10,000. Sometimes LIC comes and bids for the entire amount for 30-year bond or 40-year bond. Sometimes it happens, but not more than the notified amount. You cannot submit a bid for 12,000 or 16,000 crores. Notified amount 10,000. You can bid for maximum 10,000. You means as a participant.
But the entity who bid entire 10,000 then can allot to the single party only.
Depending on where he has bid. He has bid at 96.87. He will be rejected. He has bid at 97.
If he could bid at better at 97.25, then he will get it.
Yeah, he will get it fully. Then cutoff will be 97.25. It will not be 97.06. Why cutoff came lower 97.06? Because 10,000 crores was coming in only at 97.06. At 97.12, only 9,000 was coming. At 97.19, only 6,200 was coming. At 97.25, only 3,700 was coming. Government wanted 10,000. So if one entity had bid at 97.25 for 10,000, that will be the cutoff. Good thinking.
Okay, sir. My previous question's answer is also lying in this thing.
Good. Now you just see the other question also, please. One more question, then we can look at more doubts. Now here it is multiple price, same bids, multiple price. Okay. Now auction committee fixes the cutoff at 97.06, which is true. So again, RBI will issue stock for 13,000 crores, wrong. Okay. All bidders will be allotted stock at 97.06. That is only under uniform price. Multiple price means 97.25 वाला को 97.25 में मिलेगा, 97.19 वाला का 97.19 में मिलेगा, 97.12 वाला को 97.12 में मिलेगा, and 97.06 वाला को 97.06 मिलेगा. So this is called a bidding risk. Okay. Bidders at 97.06 will get 25% allotment. Already we have seen that, so that is true. And bidders at 96.87 will get full allotment, wrong, because they will be rejected. But all bidders will be allotted at 97.06 is wrong. Only those bidders who bid at 97.06 for 4,000 crores will get 1,000 crores at 97.06. 2,800 crores will be sold at 97.12. 2,500 will be sold at 97.19 and 3,700 will be sold at 97.25. Okay, so this is the difference between multiple and uniform. Now, if cutoff is 97.12, question, 1,000 crores will devolve on PDs because 97.12 only cumulative total is 9,000, notified amount is 10,000. So 1,000 is the gap. That 1,000 underwriting evolvement happens on the PDs. The primary dealers will have to subscribe for additional 1,000 crores at 97.12, which will be the new cutoff.
So whether there will be a situation that now there are more bidders at 97.25, which is more than 3,700?
Yes. Which number you want to put? You tell me.
No, suppose it's 5,000 is the bid at 97.25. Then how is the allocation happens?
Then also, what is deciding factor is where is RBI getting 10,000? That is a deciding factor.
Okay, so higher the rate to whoever is cutting, even if the first cut is for 10,000 itself, that person gets everything.
Beautiful. So aggressive bidding. So in a multiple price, there will be aggressive bidding. In a uniform price, there will be defensive bidding. Very good. But aggressive bidding, what happens? Against a cutoff at 97.06, he bids at 97.25. He pays extra 19 paise for that aggression. That is called winner's curse. Jeetne wala ka dukh, winner's curse. Okay. He gets the subscription bid, but 19 paise, he pays extra. Multiple price. Good.
So what is the difference between these two? I have not understood. It's same only. The last one will get 1,000.
No, that you forget now. Everybody gets allotted at 97.06 in a Dutch auction, which is uniform price. 97.25 wala gets allotted at 97.25. 97.19 wala gets allotted at 97.19. 97.12 wala
that
gets allotted.
That was the case of the previous case also.
No, that was not the case. The case was 2,800 crores will be fully allotted, but the case was everybody is allotted at 9706 uniform price.
Okay.
That is why
Okay,
in
now
2 and
now
3
the
both
price
were.
will change.
Now for each successful bidder at the respective price at which he has bid.
Okay.
Okay. This is multiple. Now, in this multiple price, what I am trying to give is the perspective of devolvement. When will a devolvement happen? This auction committee, suppose they decide that instead of 9706, let us put the cutoff at 9712, because market will look at RBI in a 6.26 yield. Yeah. Instead of that, they want to say that interest rates are, RBI wants to give an impression that interest rates are not going up so much. I will give only 6.25 yield. Lower the yield, higher the price. So between 9706 and 9712, 9712 mein line dal do, khadam kar do. So 9712, he draws the line cut off. So 9,000 only received, balance 1,000 you ask from the PDs to commit their underwriting commitment. PDs को ऊपर devolve कर दो. So that is the decision of the auction committee, whether to give in at 9706 or sell at a higher price of 9712. Whatever you bargain for Apple, 10 रुपए में 2 दे दो, नहीं 3 दे दो, last now similarly.
Sir,
So
what
this
is the meaning of underwriting?
Underwriting is a commitment that if the market does not subscribe, I will put the money. There is a new public issue coming for 1,000 crores, and then market subscribes to only 900 crores, 100 crores, I will underwrite in advance. I means somebody like a SBI Capital Markets or an LIC mutual fund, they will underwrite, for which they will get underwriting commission. But should the market take entire 1,000 crores, they need not put any money, but they get the underwriting commission. So the bidding risk is what is being underwritten by the primary dealer. Good. So
Sir,
these are the
RBI. Which system following is by RBI at present?
RBI. It will be mentioned in the weekly auction whether it is what is that uniform price or multiple price. Both systems are followed depending on the mood of the market or choice of the RBI. Both are followed, and there is it is a different science altogether, which is more interesting. From an issuer's point of view, uniform price means suppose everybody will tend to bid defensively. So RBI may have to accept a lower price. Multiple price means people will bid more aggressively. So higher price itself, RBI may be able to complete the borrowing. So from an issuer perspective, cost-wise, multiple price may be better, but uniform price means more participation. Suppose the market is not conducive and market bids are not coming, liquidity is tight, then they will go for uniform price, like that.
Okay, sir. Okay. Thank you.
Good. So we are at 12:58. I will stop here because derivatives, I have another 30% slides to be completed, but we will definitely complete in another session. I don't want to run through it. There will be a lot of overplay with your A module and some of D module also in terms of capital adequacy, savings and all. So all we will complete together in one session. It will be announced because it is not scheduled as of now. I will ask for time and I will schedule it. And we will cover the derivatives part, all swaps, options, FRAs, forwards, all four we will cover together in a separate session. Till then, keep interacting on WhatsApp and engage yourself every day. Another 50 odd days are there so that you score nothing less than 90. Good luck.
Thank you, sir.
Thank you, sir. Thank you very much, sir.
Thank you. Thank you very much, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
நீ நேரா தான் உட்காந்துட்டே